Welcome to today's feature presentation, Timeless Day and Swing Trading. I'm going to share with you that there are multiple variables to consider in your trading and how we can jointly reduce them to one dimension and produce high probability trading at predefined setups. Before we start, let me make you aware of the risk in trading, that I'm here as a trader and educator, not as a broker, dealer or financial advisor. When using technical analysis for making trade decisions, you basically have three type variables that you can control. One is the price development, the other is the volume development, or a development of statistical volatility. Yeah, it's not implied volatility. There's four options. Yeah, statistical volatility, price change over time. Yeah, and here comes the component. Time is usually the key determining factor. 80% of the decision-making basis that people operate from are price change over time, moving averages being one of the examples. 10% of the systems use about volume change. About 1% only works with volatility, 8% use a combination of, and others, and that's why we're going to operate today, they use a different way of trading. And that's what we want to do, because we want to reduce the factor time and make you different in your trading decisions so that what you do is not the most predictable. Just imagine you play a game of chess and you prepare for a tournament when it's very predictable what you're going to do and how your moves are. The other parties will try to counter what you do, and that often happens in trading. It might have happened to you. You were clear in the direction that you had mapped out, but then you got stopped and the trade commenced in your direction after, but you no more were part of the directional trade. In this little graph, we put the 5 dimensions of trading decisions together. Entry: under which conditions are you entering and opening a trade? When do you reach your target? Where is your stop to bring the trade to target? How much time do you allocate to be right in the direction that you predicted? And how do you put risk and reward based on your system probability together for accepting a trade or not? So you see, there's complexity in it. Yeah, and what we want to do here, because in that complexity, if you do a mistake in one of the dimensions, it might ruin your trading and not produce the income. And I think we did it in a couple of other examples. 76% in particular of the short-term traders, they lose money, and the reason is in the complexity and by doing a mistake in one or the other of those variables. And we want to help you reducing everything into one dimension for you and still give you a high probability. Instead of 5 dimensions, we look at 1, and we take time out of the cohesion, and we'll give you high probability trade setups above 65%. We're often even higher, but that's what we aim for. So let us go into the details together. In summary, we want to simplify your trading. We want to let the chart tell when to buy or sell. Yeah, so that's the key thing to do. So you see here, we have spelled out price thresholds: sell below a certain price point if the continuation of the next candle gets there, and you have the target by a dot on the chart. The same to the upside here: buy and get out of the trade at the target. Here's just one of the setups, and I'll refer to that later. It's called an end of purple zone setup. Why purple zone? We are highlighting downtrends in red and uptrends in blue. If you mix red and blue, it's purple and gives ambiguity. When ambiguity is over, often we get a signal that a directional price move concludes, and we give the entry and the exit conditions, and surely also the stops. We'll come to that. So we let the chart tell when to buy or sell. Before we go there, let us make a little excursion into the economic principle of an exchange. Supply and demand define the price level. So you see here a situation where there is a quantity supplied and there is more demand for that stock at the price of 100. If there is no additional quantity coming in to satisfy that need, the price is going to move up and find the equilibrium between supply and demand at 110. So meaning price move is not a variable, it is a result of a change of supply and demand. And so with that, you go on the lower basis as a determining factor, and that will help us to produce high probability trade setups for you continuously over and over multiple times a day and also on other time frames, but here today we're going to look at day trading. Today we talk about money flow. Money flow accepts the price as a resulting variable of a change in supply and demand and specifies potential setups with clearly defined entries, exits, and stops. So they all will be reduced to one dimension and will take time out. We are not looking at a 10-minute chart, 20-minute chart, or whatever in between. We'll do just look at money flow. Yeah, with our system and strategies, we want to help you to higher accuracy, which is needed, but only accepting a trade when the direction is confirmed. Yeah, so we formulate a buy or sell threshold, buy above 100. In the next candle's price movement has to be above that 100 to trigger your buy stop order. Same on the sell side, yeah? And we are exiting at a predefined target that the system calculates, where we say, okay, when that target is reached, most likely there will be a counter action, and if the price move continues, we will re-enter. And we'll do that under certain conditions, which I'm going to share with you here in that presentation. And surely we choose an adequate stop to not get stopped in the price movement, but also to keep risk and reward in a meaningful balance. We now best explain in some of the day trading examples we are looking at today here. Here's an example of crude oil, yeah, price move for crude oil from April 4 to April 6, yeah, so started out on a Sunday, commencing through Monday, and here we'll have a little bit of part of the Tuesday on it, and we'll see how the trade situation's involved. So you see here a sell threshold, sell below 60.49. The price move of the next candle ticked that out, and here was our goal. Yeah, so at that point in time, we entered with a sell stop order and we exited at that. We do a bracket order or OCO order, and that's how we execute our trades. Then there was a little reversal situation, which also let us come into trade situation 2. Again, sell 59.45, come to target, take it out. There's another one, but here you will learn with me, there's some rules to not trade in that segment between those trend lines here that our system paints on the chart, so we wouldn't have accepted the trade even though it was a good one, or we trade on lower volume or lower lot size if we accept those. Same here on the way out. In between those lines we usually do not accept a trade, but this one would have been one we took to the upside. While I recorded that picture, the price wasn't at target yet. Target is right behind that number 5 sign here, but in the development of the price you can check that too. Crude oil came to that, and so he had 1, 2, 3 times producing a little more than $500 per trade. That's a very nice income just by trading one contract. What you see here is an example of the E-mini S&P 500 futures contract, and it had a purple zone, breakout of the purple zone. 2 of our indication says buy, yeah, price is going up, and come to target and then exit. In between there were 2 signals we wouldn't have considered, and I show you later why. Then we have another after a reversal, yeah, to the upside. Target was right behind that. Then we go into a long period of time where we don't want to trade because we do not accept trades in the purple zone, for example. But right after purple zone ends, we came out here, came to target, and we do the trade. So here again, 1, 2, 3 positive trades, each for about $250 for the ES contract. So that's a nice income in a matter of 2 days. You trade more contracts, you can leverage, or you trade a smaller size, you trade the micro contract. All is feasible and possible. The important message is we are rule-based in our trading. There's certain considerations that we do, but it's learnable and repeatable. Rule-based trading leaves you very little room for interpretation. You act by what the chart's gonna tell. The chart's gonna tell when to buy or sell. And what we share here with you for the day trading concept is 8 rules when not to trade, as important as when to trade, 5 setups to look for to trade, and 2 things to consider or 2 considerations. Here you see how we spell out the rules. I'm not going to read them all to you, but I give you one example here. No entry at the exit candle. So when you come to target at that candle, there's another buy or sell signal. You're not going to take it. You're only going to take one in the continuation if there was a reversal, and then you have a new setup. Yeah. No entry at the purple zone, and so on. You'll know clear-cut when not to trade. And now in the next sequence, I show you when to trade, what are the favorable setups to look for. So trade situation on, coming out of a purple zone, ambiguity is over, directional price move is found, comes to a target. It is also clear where to put your stop. That's always formulated, and we have always a clear-cut relation between risk and reward that puts the odds in your favor with the system probability you operate from. Trade situation number 2, we call floating trend catching. So the system indicates there is a situation where the price is floating out of a containment area by 66.78. The price move of the next candle confirms the direction, so we'll take the trade and carry it out to the upside to target. When the price moves higher, we don't worry about it. We trade with our systems at clear-cut entries, exits and stop. The stops here at that red crossbar. The same here, there is the stop, there is the entry condition, there is the exit condition. So we follow clear-cut rules and we do certain considerations, but that's how we work. Rule-based trading at its best. One dimension defines your buy threshold, is defining when you get in the trade, where you put your stop, where you put your target, and you do that over and over. We colored downtrends in red and uptrends in blue, but in the trend we only trade a signal if we had a prior reversal candle. Yeah? So you see here that candle closed lower than it opened. That's a reversal candle. There was the buy threshold that we executed on. There was our target, and you saw price came back, and that's what we trade for. We trade for consecutive targets. If those are reached, we are out of the trade. The same happened here. Opposite facing candle, there we entered and we brought the trade to target. What happens after doesn't matter to us. Never lost trading power towers. They point the way. Yeah, the light tower stands tall and points a direction, but we're not going to take the first one on an opposite move here. That would be the first leg on an upside price move, but the second is ours to take, clear-cut rules, and we bring that to target. Then we have a reversal candle here as explained in the prior example, and within that validates that second trade to the downside. And when we come into the last section between those trend lines that our system paints on the chart, we're not going to accept shorts, and we only accept the second part of an up wave or an up move, so we wouldn't have traded those last two even so they came to target. We'll have clear-cut rules. We know when it's higher probability to bring the trade to target, and that's what we follow. As explained in the last example, we in particular take focus on these trend lines and the action in between. And here we only take a trade if the candle, which has the trend initiation signal, is poking through that second trend line in between there, else we would not have taken it, but that was the fact. So we carry that out as a trade. Here we would have the reversal signal taking it home, but here in the end zone here we would not have taken that trade nor the reversal, but the trade out of the box. Even so, it looks pretty, and all of these worked out here. We trade by rules when to accept and when not to accept the trade, because we want to reach a probability above 65%, and this is how we do it. What I explained to you now shows you how we can find good trade setups, solid trade setups here again for crude oil, and bringing them to target. Look after the reversal, bringing them to target, not trade when there is not such certainty, but trade when we have our conditions together. Do all trades work out? Absolutely not, but we have high probability setups and high probability rules that we all have documented for you, and we work for multiple hours with you to make them stick and put into your day-to-day routine for executing trades for multiple of different underlying assets. going as live as possible. You see here April 7 and I'm recording today at April 8. Yeah, so here we had certain signals. Yeah, so we can't hold the system back to print those signs, but we're not going to take them because in that last segment we're not going to take shorts. We're not going to take the first long either, even so it worked out. But this was a trade, yeah, end of the day carried into the next, but you could have entered here and brought the trade to target in the overnight session. Then we have the reversal, yeah, so that was the exit candle, not this one. The reversal to the upside will take it. This one we would not have taken, two reasons. First of all, it's the exit candle of that signal. Second, the target is across a line line. So these rules and all of that, they are learnable. They are easier than traffic rules. You're not going to be running over a red light and assume that it'll always work well. And so with that also we share rules that work well in the long run for the traders that are able and willing to execute rule-based trading. Make a difference to your trading. Rule-based and come on board to high probability trading. We are ready for you and will teach you in 8 hours what is needed and how to execute the concept. Definitely we have everything we say also in writing. We'll install the indicators on the charts for you. We have 2 months of coaching ready for you to help you on a horse so that you do the right things right and the wrong things you stop doing. And we give you 2 months of alerts if you want to trade on higher time frames or execute different orders. Yeah. So here we put a little special offer together for you. NLT trend catching indicators sell for 6,997. We give you the box extra value of 997. We give you the timeless tick concept that I shared here today, 2,997, but it requires the basis of it, the trend catching indicators to see the chart. 2 months of alerts and coaching, $990, a total value of $11,981, but my special offer here to you, $6,497, a savings of $5,484. The key for an investment is also always how fast can you have a return on this. So if you start with an initial capital of 50,000, the system costs you 6,500, you have a remaining capital of 43,500, and with a 2% risk you could have $800 of income or risk per trade. So within that you could have, when everything works out, a very quick payback on the investment, and then basically you will trade for free because you have paid yourself back the tuition and you have the knowledge of what we teach you. We are happy to show you live what the system can do for you, so we offer you a free consulting hour. So call our office or write an email to contact@neverlosttrading.com, subject consulting hour, and we are happy to demonstrate with you and afterwards work with you. We're looking forward to hearing back from you. Thank you very much for your attention.